Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, February 8th. Kind of light data for economic data this week, but we do got, of course, the weekly jobless claims for this week. So we had 230,000 people applied for unemployment last week. Forecast is supposed to be kind of in that range, maybe a little bit higher at 235, and it came in at a very low number at 221,000. So if you look at the past 4 weeks, the average is about 225,000 people applying for unemployment. That's the lowest since 1973. So huge. That's I mean that's obviously great news there. The jobs right now it is tightening. We're seeing wages rise as a result of it. So that's the reason why some of the panic is in regards to inflation with the tightening job market and wages rising. So the consumers or the investors, a lot of them are concerned about possible inflation, which in turn will go make the Fed increase rates more rapidly and or get a little bit more aggressive with it. They're already scheduled to do three this year. First one starting in March, which will be the first underneath the new Fed Chairman, Jerome Powell, or also some people call him Jay. I believe that's his nickname. But in any case, the economy is doing well. So the reason why stock market now needs to get used to this new market. We've been such a stagnant market for such a long time. Now that the economy is heating up, now they got to get used to a normal market again. We haven't really been in a more normal market for for about a decade, or for over a decade for that matter. So let's kind of jump a little bit further into the headline news. So as a result, stock market's down again today. We've been, the Dow's been down over 100 so far today. We've been getting a lot of these seesaw things that have been kind of seeing the markets go up and down a little bit. We'll see it going positive and then end in negative. So just I guess we're gonna have to just kind of ride this wave, so to speak. Just you're gonna have to kind of sit still because not much we could do. Part of this is again, a part of this is more emotion. It is looks like to be maybe part of the correction we've been kind of waiting for in the stock market. So just I guess hold tight. And same thing for bond market. We're starting to get used to a new environment too, getting into a normal market. So the bond market is also been tanking a bit. So which in turns, higher interest rates are rising. So the long-term interest rates, like your 30-year fixes, are going up as a result of this. Now we do have a lot of Fed speakers speaking this week. We did have, for example, today we'll hear later on today will be Fed one of the Fed members, Harker, will be speaking. Yesterday, Evans came out and basically he kind of eased it a little bit, but he's a non-voting member and he is known to be a bit dovish. He basically doesn't think the Fed has to raise rates dramatically this year. He thinks that the inflation came in, with wages, but that necessarily influenced the consumer side of things. So he doesn't think the inflation the data we saw is necessarily the bad inflation. It's more the good side, and it doesn't necessarily translate into rising consumer inflation. So that was his thoughts, what he kind of mentioned yesterday. Let's go ahead and go over to the bond market. Bond market, as you see, we've been going down, and again, we dropped quite a bit. We were right now, it's right here is about 25 basis points, but as you can see, we were down like around 40 basis points earlier this morning and have kind of pulled up to this line of first level of support here. So again, these could be very well broken here, continue to break down further as the Treasury yields keep rising. And you'll see Treasury yields go up here a bit more. So you can see this, we're now up to about 2.87. Looks like we could be on our way up towards the 3% range in the treasuries before we see much. That could, this might hit about 290-ish, or again, long term, it looks like we could easily hit 3% here. And and yesterday we had treasury auction that came in pretty disappointing, especially with the high yields we've been presenting, and that student it came in at like like a C minus rating. So therefore, bonds kind of went further down, kind of tanked a little bit further. We do have another auction going out later today, and we'll have to see if that may translate. That's again, that could push bond prices even further, and hence again pushing rates higher again today. So again, rates are higher today as a result. The bond market is down, and I guess we just kind of have to hang in there. Hopefully, you guys out there that are in the middle of refinances or purchasing have locked in. If you guys are in the middle of looking, hopefully you guys can lock in now, or unless you want to play with it, see if it gets better, later on. That's an option too. A lot of lenders don't lock in, while you're looking. We do that. We'll do it for people who are listing listing the houses to maybe want to buy, to those who are out shopping around, or even those who are uh, building a house and need the mortgage. We can lock you guys in advance of those. So uh, if you're interested in that, just reach out. Feel free to reach out to me, and we can talk further about those scenarios. All right, you guys uh, want more data? Just come over to Twitter and Mike Bjork. Otherwise, you guys have a great day. Thanks so much for watching. Look forward to you guys tomorrow. Bye bye.